Hi, everybody. Welcome to 7 and 7. I'm your host, Zack Ellison. And with me today is my good friend and leading investor, Christian Gannon. Christian, you're one of the best investors I know, and also my classmate at University of Florida in the
Yeah.
doctoral program in business administration. And so I'm excited to have you here today. And we're really just going to focus on your best piece of investment advice and really understanding what got you here. So let's start with a little bit on your background and how you got to where you are today in the investment industry.
Yeah, thanks, Zach. That's very kind. So I got into the investment industry a little over a decade ago, close to 15 years now, and really I got into the finance industry just because I wanted to help people. And as I got in, I found that the investment side was really interesting. I think there's always something to learn. And I equate investment management to a 40,000 piece puzzle that you're looking for the right 15 to 20 pieces to put together for a client. And there's no right or wrong way to do it necessarily. And the puzzle is never really complete. So it's always kind of a new challenge. So, I've had the luxury of working for large organizations and small organizations. I've worked on I started out on the client side, and then I worked for an alternative investment firm doing manager research and building hedge fund and private equity portfolios. And then I built models for bank wealth management platform, and now am CIO for a $2 billion RIA down here in Huntsville, Alabama.
So tell us a little bit about your current role and what you're focused on now.
Yeah. So like I said, I want to help people, and that was, I love the research side. My passion is finding ways to build better portfolios for clients. Every day there's new things coming out of the industry. And so there's always something new to learn about and consider. And I think for a lot of people, that's really overwhelming. I'm really passionate about learning and diving into these new things. And finding ways to build better portfolios, I think that there's a couple of key things that I'm focused on. One is simplicity, and two is resilience. I think that we as an industry build really complex things, and there's a lot of different reasons for that. And so, what I want to do is find ways to bring simplicity back into portfolio construction while not sacrificing the resilience that we can get from having really interesting investment strategies included. The second thing I would say is personally, and you talked about pursuing my doctorate. I want to use the research skills that we develop from that kind of more academic environment to help the entire investment industry get better at what we do. I think that we have such an important role that we play in the economy. Everybody has money, everybody's investing, and so I want to help find ways to contribute to the growing collective knowledge that we have as an industry.
So I want to start the 7 key questions, and we're gonna get into the meat of it. The first question is, when you think about investors you admire that you've learned from, what are the characteristics that they share, and how do you utilize those in your own work?
Yeah, I think desire to learn is a crucial component. The other 3 things that I would highlight are conviction, calmness, and humility. I think that the investors that I admire are comfortable regardless of circumstance, because they put the work in on the front end to really think about the strategy that they're trying to execute. And so, what that does is it helps you when you go through periods of stress and periods of exuberance. You're able to not get too high or too low. And so, those people that I've had the pleasure of working with, that's been one key thing. The other thing, and I think it lacks seriously across our industry, is humility. And there's this fine balance between confidence and hubris, and we want to be confident in the decisions that we make. But what I found is that good investors are willing to challenge their own assumptions and to learn from their mistakes. And the first part of that is identifying mistakes and being willing to, being willing to admit that, hey, we made a mistake and now we can grow from it. So, I always tell all my analysts, it's okay to make mistakes. Nobody bats 1,000. What we want to do is try and learn from those mistakes. So those are the things, I think desire to learn, conviction, and calmness and humility are kind of some of the big characteristics that I try to exude for my clients day in and day out.
Yeah, those are great characteristics, and one I'll add to that I think is being innovative and open minded. And we'll get into that because I know you're very innovative and have spent a lot of time in the alternative investment space, which ultimately is where most of the innovation is occurring. So with that, what's something that you're thinking about right now in the investing space that you think most people are not thinking about? That's important.
I think the biggest thing right now, and it's it's probably common in any periods of stress like this, but the economy is not the market, and the market is not the economy, and too many people conflate the investment market with the economy, and I think that's why you see Warren Buffett's advice to be greedy when others are fearful, and vice versa. It makes sense because most people, when we go through periods like this, they think this is the worst time to put my money to work. Everything is so bad right now. We think linearly as humans, and so we just picture these trends continuing into perpetuity. The reality is that the economy is a present indicator. Investing is for the future, and so what we need to think about is how the present affects the future. But we want to look forward as we're putting money to work, and do we think that we're going to be better off 5 or 10 years from now? And so even after a 20% sell off like we had in 2022, most people, if they've been invested for the last 10 or 15 years, are better off than they were 10 or 15 years ago. So I think it's one of those things that people get really caught up in the moment, and what we have to do as investors is to look forward. How can we? And that's where I think being innovative, being creative, thinking outside of the box is a really valuable tool as an investor.
Yeah, you hit on some really interesting points there, and I agree in that a lot of folks are very backward looking, and so when there's dislocation in the markets and that create opportunity, they often miss those because they're thinking about what happened in the past and they're not thinking about what's coming up next. And nobody will admit that to you. They don't even admit it to themselves. I think they're unaware of that bias and heuristic, essentially. But there's a lot of that anchoring to what's happened in the past. And I think very few people that are able and willing to innovate and seize the opportunities. And then in hindsight, they always look back and kick themselves. Like if you could go back to 2010 and invest in private credit, for instance, you would do so. But at the time, nobody wanted to do it because they were all scared. And right now, we've got some really interesting opportunities that we'll talk about, like within venture debt, for instance, with the failure of Silicon Valley Bank. And, I think some people will seize that, but a lot of people will miss it and look back in a decade and say, how did I miss that? It was so obvious in hindsight. But when you're in the midst of turmoil, it's kind of hard to think clearly.
Yeah.
So let's talk about some of the investment principles that you live by. Have you talked about the characteristics you admire in some of the top investors? But are there certain specific investment principles that you think every investor should be thinking about and that you utilize in all of your portfolio construction?
Yeah. So the first one, and it's simple advice from Warren Buffett and many other great investors, is just buy good businesses, right? It's not sexy, but it works. And I think what it becomes really challenging in periods like the last 10 years because, just buying good compounding businesses that you have a really good long-term thesis for that have really strong market positions. They're often not the ones that are at the top or the bottom of the heap in any given year. And so it's challenging. You can get FOMO and, you see people making a bunch of money in these other areas and it's like, oh, I need to start chasing some of those things, but just finding good businesses to invest in. And I think, this is what the patience is an investor's greatest asset. When you look at, and I tell people all the time, it's not about, finding that magic bullet that's going to get you 10,000% in the next, couple of years. It's about being really consistent and disciplined and, and having a plan and putting that to work day after day. The other thing I would say is I have a good friend of mine that I used to work for, Tom Riggert, and he always told me to be skeptical in the research process. When somebody comes to me with something and it sounds too good to be true, it probably is. And so we want to start at a point of no and try and find any reason not to invest. And then if we get to a point where we're comfortable and our reservations have been taken away, then it may be a good investment. But too many people are afraid to ask questions in the process and really try and understand, what somebody is actually bringing to you. And some pitches just sound too good to be true. And chances are, if they are, what we've learned from the past is chances are if it looks too good to be true, it probably is.
Chris, I think you nailed it. So just to summarize, good businesses, patience as an investor, being very disciplined and being skeptical and what I would think of as being risk intelligent.
Yeah.
Thinking about the downside, not
Right.
just caught up in the upside. One thing I'll add to that we've talked about offline is price versus value as well. So
Yeah.
you want to make sure you're buying the companies or investing at the right price. And sometimes there's assets that might not be attractive in terms of some of the characteristics, but they might be priced in such a way that they still offer a substantial upside. And that's ultimately what some value investors look at, like Warren Buffett, buying businesses that maybe aren't always what we call great businesses, but you're buying it at such a advantageous price that you've got
Right.
a lot of upside there.
Yeah.
So that's the thing I think a lot about is price versus value. And I've noticed there's a lot of folks that don't talk about one of those two in the context of the conversation, and they're missing it. And they're saying, "Oh, this is a great company." And my thought is, well, yeah, but where's it priced?
Right.
And then they'll say, "Oh, this is a risky asset, but where's it priced?" And so without the price being mentioned in the context of the conversation, I think you're missing the key component. So with that, I want to move on to talking about alternative investments, an area where you've got a ton of experience and expertise. And quite frankly, I think you're a forward thinker in the area. I think a lot of folks are still very conservative and anchored to stocks and bonds, and they're missing just huge opportunities and alternatives, whether that's real estate or private equity, private credit, venture capital, commodities, et cetera. So just quickly, what do you think is most attractive about alternatives broadly, and why should they be included in most investors' portfolios?
Yeah, so I'll separate two things. So when we think about private markets, private equity, private debt, private real estate, what we've seen a trend over the last 2 decades toward companies staying private longer, and a lot more things happening in the private markets than in the public markets. Public markets have shrank from 8,000 stocks, 20, 25 years ago to now we have about, I think, 3,500 stocks in the U.S. And so there's just a much broader universe of opportunity that's available out there to investors. And I think the more that we see that, the more that we see that trend continue, it really broadens the opportunity set, the ability to go out and find opportunities where you can be patient and where you can find idiosyncratic opportunities to invest in good businesses that are not available on the public market, whether that's through equity, debt, or real assets. And so I think just that that, as well as I think that private strategies help in remedying a lot of the behavioral issues that investors have. Investors are naturally short term, like we've talked about, and so some of the limited marks that we get, and there's some research coming out on that, is more of a feature than a bug for a lot of these strategies. That it allows investors to think longer term. It allows good investment managers to create and unlock value and not think about what's this going to look like on next quarter's earnings statement, but what's this going to look like over the next 10 years? And that's a much more attractive proposition, and one that gives you a lot more control as an investor. So I think that's a really, really attractive characteristic of these types of investments.
So within the alt space, there's a lot of focus on identifying unique and differentiated strategies, and oftentimes those are coming from emerging managers that have started new strategies that others haven't yet gotten
Yeah.
involved in. In broad strokes, what are some of the advantages of investing in emerging managers?
Yeah. I mean, the research shows that managers generate the most alpha when funds are small and in earlier stages of the life cycle. And so, yeah, I think one of the big things that I think about as an allocator is alignment of interest between me and my investors and the investment manager. And there's really strong alignment of interest in those early stages because, emerging managers haven't generally generated, they're not multi-billionaire private equity managers at that point, right? All of their capital is tied up into this one, into making this one thing work. And so there's really strong alignment of interest there, which is really attractive. The other thing is that, one of the big thing, inefficiency drives the ability to generate returns, and inefficiency is so much more prevalent at smaller investment sizes. And so when we think about, even in more mature investment managers, those that, grow their funds to a certain point, you start to see this leveling off of the value they're adding, and it's not the same as they added at earlier stages. So, having the ability to be selective in the, in where you're putting capital versus trying to just buckshot all across the market and buy everything you can because you've got to allocate this capital, but being able to look at 100 investment decisions and pick 2 of them that you like, pick your 2 favorite ones, like that's a really attractive trade-off to me. And for emerging managers, you have a much greater ability and need to do that than as you grow and become more mature. And it's kind of like we talk about in the advisory business. Most of the clients, when they come to us, have already made their wealth, and you make your wealth using idiosyncratic risk, concentrating your exposure into, a single investment or a small number of investments. You maintain your wealth by diversifying across lots of different investments. And I think you see that trend in, in larger private equity, private debt, larger investment firms in general, is that you've made it, and now you don't have to take as much risk to get there. It is as when you're an emerging manager and you're thinking about, well, how am I going to build this and grow this? How am I going to get this to fund 2 and fund 3 and fund 4? But, a big part of that is going to be strong performance in the early stages.
Great points, and that a lot of people, I think, overlook. So we've got 2 more questions, and one kind of dovetails into what you were just talking about. And the question is, with an emerging strategy like venture debt, there's now a huge catalyst in the market for strong performance, given that Silicon Valley Bank and other lenders that were prominent in the space have now collapsed and are out of the market. What is it that you see in terms of venture debt and private credit broadly that you think is attractive in this next part of the cycle?
Yeah, I think again, the opportunity set is very large, and I think you're able to. There are more people that are seeking and more opportunities to go out and find funding outside of traditional banks that may be more advantageous. I think in venture debt specifically is interesting. One of the things that I've reviewed it over the last couple of years is low LTVs with high yields. And I think for a lot of people, they look at, a lot of the misconception is you get debt-like returns with venture capital risk. And I don't think that's true, in that, the LTVs on most of the venture debt deals that I have looked at are so low. There's a lot of protection there for the credit investor, that if there is a default, there's the ability to come in and there's plenty of coverage to be able to cover the amount that's being lent there. So that's really interesting. I think the other thing is that, there is this incentive for, for the company. The company wants to hold on to as much equity as they can. If you're at early stage, an early stage venture company, you think this is going to be something much bigger. And so you want to hold on to as much as you can in the early stages. And I think it creates this strong incentive, that you're trying to hold on and grow this. And so, paying back that credit, like it's a very interesting payoff that I think is a good trend for the industry as a whole, that we keep, more of that equity ownership in the entrepreneur's hands versus passing it off to, private equity firms and things like that. Private credit, I think, just in a lot of the private credit space, you see a lot of senior secured lending and things like that. And there's lots of different ways to create asset-backed structures and securitize different things, and for managers to have more ability to have control about the risk that they're taking. And that to me as an investor, when I'm working with somebody that has the control to be able to control what covenants you're getting, how you're being protected, those kinds of things, that's really attractive to me relative to the more traditional fixed income markets.
Great. You really nailed it, I think, in terms of the ability to control the structure, I think is a huge de-risking mechanism in general for private credit. You can take a good company and then you put a really tight deal structure around it and it de-risks it further. So last question of the day, and then we're going to have one bonus question, but the last of the 7 questions is, what are the key investment themes that you see for the next couple of years in your mind? Just the top 2 or 3.
Yeah. So I'll give you the first one. I think as we come out of a zero interest rate environment where we've had, massive growth, really accommodative, expansionary monetary and fiscal policies coming out of 2008, I think that what you see is, as we are in a higher interest rate environment than we've been in 15 years, inflation is probably going to be higher over the next over the next 10 years than it has been over the last 20 to 25 years. So to me, a return to the importance of cash flows as a metric in thinking about companies moving away from, we've been in an environment that's been driven by multiple expansion and using leverage to create value. That's going to be a much more challenging theme to carry on over the next 5 to 10 years. So I think cash flow and becomes a much more important consideration for investors. The other thing, and it goes back to what we've already talked about, I think private markets offer a really attractive opportunity, and I think we're going to see a continued growth in the strategies being offered and continued innovation in the way that we get that into more clients' portfolios. The other thing is, it will be interesting to see how if we coming out of getting into an environment. So the 60/40 portfolio tends to work really well in disinflationary growth environments. There's a chart from a group called Resolve Asset Management that they show, the real returns of a 60/40 portfolio. And what you see is disinflationary growth environments tend to be really good for, which is what we've had the last 20 years. Over the next 10 to 20 years, I think there's going to be a more demand for alternative assets that can help to bolster that 60/40 portfolio. It's going to be challenging to see the type of the growth that we've seen in the 60/40 over the last 20 years, over the next 10 years. And so there's going to be this demand and hunger for some alternative assets to bolster portfolios.
I couldn't agree more. I think alts is where the world's headed. And you see, I've got my Florida Gators hat on now for the bonus question, which
Nice.
is, why does the University of Florida have the best doctorate in business administration program in the country, in your view?
Ooh, that's a great question. I think the rigor of it and I think about what we not to, if Phil watches this, then that's great, Phil. You can pay me a tip, but yeah, I think the rigor of the research methods courses that we take, and Phil, Dr. Podzakov's focus on that as a key driver of the of the process is such a huge differentiator. Having the level of faculty that we have and the resources that we have, it's man, what a value add. I didn't realize how how hard conducting good, rigorous academic research and making sure that you're testing the things that you want to test. And that, to me, having somebody like Dr. Podskov, who's been cited thousands of times just on methods and leading you in that process is a huge value add.
Yeah, I agree. I mean, my favorite part of the program is the professors and our classmates and the gear, of course. right? I think I've got more Gator hoodies than probably anybody in Los Angeles. And
Yeah. The blue and orange looks great.
So, Christian, thanks so much for coming on today. I really appreciate your views. Thanks everybody for listening, and see you on the next 7 and 7.